Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. As you were talking there, I just noticed a new jumper.
New for the studio, I think.
Uniqlo?
Absolutely. Yeah. New jeans as well, actually.
Oh, okay, all right. Calm down.
Freshly back from Melbourne, and found a little place that takes old jeans and tailors them to you. So I have never had a comfortable pair of jeans because my legs are short and my thighs are big.
Okay. So wait, they're old jeans that you owned that were tailored to you?
No, they're like Levi's and stuff that they have there secondhand.
Okay.
And then you find a pair that kind of works, and then they stitch it all up to fit you properly.
Did you tell them about your Levi's mining story?
No, I didn't get that far.
For people unfamiliar, Bryce has found a new obsession with old mines
1850s, yeah.
Where there are old pairs of Levi's jeans which sell for six figures.
Yes.
And that is what we'll be talking about in today's investing episode. No, look, we've got a big episode here. We are going to cover the news moving markets, including Warren Buffett's big mistake. Speaking of big mistakes, we're going to talk about Bryce's quest to turn $500 into $5,000.
Fair call.
And then we're going to close it out by bringing back the Unhelpful Desk, where we give general advice in response to your very specific questions.
News and markets.
Headlines we're going to be covering this morning: Buffett's big mistake. There is more of the same for the Australian property market. Bitcoin hits all-time highs, and Australia's greatest infrastructure project is not what you think it is.
All right, well, let's start with Buffett's big mistake. For people who are new to the show, welcome. Warren Buffett is arguably history's greatest investor. He took over a failing textile mill, Berkshire Hathaway, in 1965 and turned it into one of the giants of American business, $1 trillion company. It recently ticked over. Buffett is famous for some of his great investments over the years. Gillette, the Washington Post, Apple more recently.
Coca-Cola.
What else stands out? Coca-Cola, American Express.
Yeah.
He's picked some winners over the journey, but he doesn't always get it right.
He doesn't, no. So in 2015, they took, Berkshire took two very well-known consumer brands, Kraft and Heinz.
Yes.
And
Kraft known for slices of cheese.
Yeah. Baked
Heinz
beans.
known for baked beans. Yeah.
Cheese and baked beans.
Two of the biggest food companies in the world.
And smashed them together. Yeah, so orchestrated a merger between the two major food giants. However, a decade later, it hasn't worked out. So the share price has fallen more than 60%.
Yep.
I think something like $30 billion or thereabouts has been wiped from its market cap.
No. 30 billion is left.
Oh, left?
Almost 60 billion has been wiped off. 57 billion has been wiped off.
Well, there you go.
Yeah.
So it hasn't actually worked out as, I guess, Buffett would have hoped.
Yeah, Berkshire owns a little over a quarter of the combined company. And yeah, it's down about 2/3 in a decade. Between 60 and 70% in a decade. So Buffett doesn't always get it right. They are recognizing the error of their ways, though, and Kraft Heinz is reportedly breaking up.
Yeah.
Now, you would think the simplest way to break up would be you take your assets, I'll take mine. Heinz, you take your baked beans. Kraft will take our sliced cheese. But no, they're actually thinking about splitting it up in a different way. So food products is going to be one company, but then the faster growing segment of condiments, sauces, dressings, and spreads will be its own company as well.
So they're just really spinning off all of the stuff that isn't growing, it sounds like.
Yeah.
And just saying, this is where the growth is. Let's focus our time and energy on this.
Yeah.
And whoever's left with the scraps, the cheese and the baked beans.
They're
might also perform better as well, you would think.
They're deconstructing the hot dog. On one side is going to be the bun and the sausage, and that's the slower growing side. And on the faster growing side, the tomato sauce and the mustard.
Yes, nice.
So look, if you're feeling that you've made a bad investment, don't despair. Even history's greatest investor gets it wrong at times. The important thing is he's recognizing the error of his ways and doing something about it. But Bryce, let's move on. Let's talk Australian housing. I think we're headlining this more of the same for Australian housing, but there's really 3 quickfire stories that we think are worth talking about. Let's start with our friends to the north. Let's talk Brisbane because it has had a pretty remarkable rise. Brisbane house prices, not apartments, houses, up 76% since 2020, almost doubled in 5 years. Brisbane is now $1 million home market. The median home in Brisbane is over $1 million. It's now the second most expensive housing market in Australia.
Yeah, I was actually just looking at that.
Were you?
Yeah.
That's funny because we're talking about it now, so it's good you're looking at it.
No, I was just trying to suss where it would fall. So it's just behind Sydney. Well, I say just,
No.
but Sydney's light years in front.
So median house prices, and this is from Cotality, which was CoreLogics. For some reason, they changed their name. So this is homes, not apartments. Median home in Brisbane, 1.01 million. Median home in Sydney, 1.5.
Yeah, it's unbelievable.
Yeah, specifically 1.496.
Yeah.
But you round that up.
I thought a few months ago it peaked at 1.7, so good to see it's come back down a bit.
The interesting thing for me looking at Brisbane as well, so this time a year ago, well, in June last year, Brisbane was the 4th most expensive housing market. It's leapfrogged Canberra and Melbourne in the past 12 months.
Wow.
Yeah.
What's Canberra?
Well, here's a question for you. What do you reckon is number 3, Canberra or Melbourne?
Well, I know Melbourne is just shy of $1 million.
Melbourne is 948.
Yeah.
Canberra, 981,000.
Oh, okay, there you
Canberra
go.
is the 3rd most expensive house market.
Yeah. So for houses, there's $2 million markets, Melbourne and Sydney. The rest just
No,
shy.
no. Brisbane and Sydney.
Oh, sorry, Brisbane and Sydney. Sorry, Brisbane and Sydney. The rest then Canberra, Melbourne.
Oh, you're going to do the
Adelaide,
list.
Perth.
Go.
Canberra, Melbourne, Adelaide, Perth, Darwin.
No, Hobart.
Oh, Hobart. Forgot about Hobart. Anyway, we did say these would be quick.
Yeah. Well, I think just the one thing to call out, obviously Brisbane has all the same factors that the rest of Australia has, but they have one additional factor, which is they're getting a lot of interstate migration. So people moving from Melbourne and Sydney and other parts of the country, but particularly Melbourne and Sydney. Greater Brisbane's population grew 9.2%. Between June 2020 and June 2024. Compare that to national population growth of 6% in the same period.
Where the population goes, housing pricing goes as well. The second headline making news in housing is that there was an unredacted Treasury brief that was sent to the ABC when they asked for a freedom of information.
Yeah.
Now, it warned that the Australian goal or the government goal of 1.2 million houses is not going to be met.
Yeah, quote, won't be met.
Won't be met.
Yeah.
Now, this is not surprising.
Yeah,
I
we
don't
all know.
think.
Yeah. Well,
no one really believes that it's... Well, I mean, when the Treasurer was asked yesterday if he still believes it's going to be met, he said yes.
The briefing was like, you need to do something radical.
Yeah.
Like, it won't be met
Yeah.
based on current,
Change tax and the like.
Well, that was a separate thing.
True,
It was also
true.
meant to be
Sack
redacted.
that.
Yeah. So look, I don't think there's much point dwelling here. Something radically needs to change to build 1.2 million houses by mid-2029. So we'll keep talking about it and hope things change. Let's move to the third story, which is more immediate, which is that for the past 5 weeks, Australia's national auction clearance rate has been above 70%. And that is on the high side.
Definitely.
That is a signal that demand is high in the market. The fact that we didn't get a rate cut and then the weekend afterwards, the auction clearance rate was still above 70% shows that buyers are trying to get in. There's an argument that they think prices are going to keep rising as rates keep getting cut over the next year and a half. And so they're trying to get in before prices go up. But ironically, that is pushing prices up because there's so much demand in the system.
Yeah. So to put it in context, the lowest clearance rate in 2025 in Sydney has been 54%.
So I guess if we round up this housing chat, as we said, more of the same. Limited supply, we're probably not going to hit that 1.2 million goal. Increasing demand, auction clearance rates continue to be high. And ultimately, it all adds up to rising prices, best exemplified by what we started with in Brisbane.
Yeah.
More of the same.
More of the same. More of the same. We'll keep talking about it though. Let's keep moving, Ren. So Bitcoin has hit all-time highs. It's crossed over the $120,000 mark, hitting US $123,205 last Monday.
Yeah, it's been a pretty incredible run. I think it's up almost 70% since the post-Liberation Day lows, where it fell into the 70s, and now it's in the 120s. So pretty amazing. Why has it had such a good week this week? We're in crypto week in the US. I don't know if you've been following this,
Yes.
but there's 3 laws that are currently before the House and the Senate. There's the Genius Act, which would regulate stablecoins. There's the Clarity Act, which would, I guess, set broader rules and structures for the crypto industry. And then there's the Anti-CBDC Surveillance State Act, which would ban the US Fed from issuing digital currencies or stablecoins. And so obviously the prospect of more support from the US government and more clarity over regulation in the US has seen the price rise.
Yeah.
But it is also just a story of supply and demand, I guess. And, you know, there's the reflexivity of, as the price keeps running, more people get interested in it. And so then people believe in it more and then put more money towards it. But it is incredible. Yeah, as I said, almost 70% up from post-Liberation Day lows, up more than 100% in the past 12 months, up more than 1,000% in the past 5 years.
I think once again it topped the list for the best performing asset class of the financial year.
Unsurprising.
Yeah, so,
yeah. I mean, it hasn't outpaced Catapult in the past 12 months.
I would say overall asset class. There are definitely some stocks that have outpaced it, that's for sure. But you're right. I think Liberation Day, it hit 72,000. So
Buying opportunity. Imagine if we bought Nvidia and Bitcoin on the 9th of April.
Yeah, well, I was looking. I was looking back. It'll actually come up in the next segment when I look at how well I'm going in the 500 to 5,000. We look back at all those moments, and as we say, there's never a pullback that you look back on and regret buying into. Yeah. And some of those individual stocks that have ripped from Liberation Day, it's like.
Yeah. 2 thoughts on crypto and Bitcoin as we close it out. The first one is what is happening to Ethereum. So Ethereum is down 4% for the year.
Yeah.
It still hasn't topped its 2021 highs. So that's one that I think is curious. I dollar cost average equally into Bitcoin and Ethereum.
Oh, damn.
Yeah, which is
sack that.
Maybe subject to change. But I think the story of crypto, and this isn't a new story, but each new bull market makes the previous one look small. So just to put it in context, 2017, Bitcoin peaked at $20,000 US.
Yeah.
Then it fell almost 80% or more than 80%. Crypto winter. Then the new bull market in 2021, it peaked at around $65,000 US. And then it fell 80% and we had another crypto winter. 2022, 2023, rough. And then the bull run started again. It's now $120,000. And who knows where it will go. I think a lot of people say 150,000.
Yeah.
And then, but who knows?
150 by October.
Is what they're saying?
That's the
call.
call.
Or what you're saying?
That's the call if you're following the M2 money supply thing.
But then
watch this space.
But then it will fall 80%.
Sure. I don't think it'll fall 80%. I think the days of it falling that much are gone with so much institutional money in it.
Well, we will wait and see.
Yeah.
But yeah, pretty incredible run for Bitcoin, but strap in because the roller coaster goes up and down. I think is the point.
Love it.
All right, well, let's close it out with where we share one story that caught us by surprise. We also do this each day in our daily news email, so you can sign up to that at the link in the YouTube description or the show notes. But Bryce, what had us saying what the this week?
Well, we're going to move down to Tasmania to look at one of Australia's greatest infrastructure project. And no, it's not the stadium that has made headlines nationally, the AFL stadium that has split the state down there.
Yeah.
It is a promise from Tasmania's Premier, Jeremy Rockliff, to build the world's tallest chocolate fountain.
Yeah.
Love that.
This needs more attention. So chocolate tourism was a big thing for Hobart, the Cadbury factory.
The Cadbury, yeah.
But they closed. Did you ever do the tour?
Nah, no.
I did, but it was interesting. But they no longer take tours. I think the last one was in 2010. So chocolate tourism is dried up on Tasmania, but they're gonna bring it back with the world's tallest chocolate fountain. And you know that had me researching what is the world's tallest chocolate fountain.
Dubai?
Not Dubai. That would have been a good guess. No, according to the Guinness World Records, it was actually in Austria.
Okay.
You know, the Europeans, they love making chocolate.
Yeah.
12.27 meters tall.
And so the Premier is obviously going to try and build something taller than that.
For people watching in YouTube, we'll insert the photo. That's the world's...
So it's just actually a big fondue fountain.
It's a big chocolate fountain.
Yeah,
Well, what did you expect?
I was expecting it to be like flowing over.
Oh, you were expecting like Willy Wonka.
Like,
vibes.
yeah. that would be an attraction. What you're showing there, I don't think that's much of an
You're
attraction.
saying if you can't do an Augustus gloop and get sucked up into it, it's not a chocolate fountain you want to see.
I think Tasmania should focus on getting the stadium done, which I think will result in some pretty good levels of tourism regardless.
Bryce set himself a big target this year, turn $500 into $5,000. We're more than halfway through the year, so we're checking in to see how Bryce is going on 10 bagging his money.
Yeah.
Bryce, how you feeling?
Oh, I'm feeling a little deflated, to be honest, Ren.
You know what? The enthusiasm with which you attack this segment, I felt it around the office, you know? At the start of the year, there was a lot of chat.
It's just because it's such a mind warp, like putting energy and time into it results in...
What did you expect?
Well, it just results in bad behavior. And now I've decided to take my hands off it and let it run. And it's resulted in a bad result.
Oh my God. All right. Well,
do you know what I mean? So I'll tell you where we're at.
The idea that you thought you would 10 bag your money without putting any, quote you, energy and time into it.
Well,
of course it was going to take energy and time.
More like, yeah, but I look back and I'll go through it here because I just look back on some of the opportunities that were in the portfolio to begin with, or that were on the watch list and have traded out of them.
You just should have bought a leveraged Bitcoin ETF.
I should have just bought some companies. But anyway, let's just start from where we left off for those that have just joined us for the very first time.
For those that have joined us for the very first time, this isn't how we recommend investing generally.
Not. Absolutely not. This is purely
for the content.
Fintertainment.
Yeah. Fintertainment. We haven't used that before.
Yeah, fintertainment. Antipa Minerals was in my portfolio, which is a gold explorer at $659. So I started with $500. Bitcoin was in the portfolio at $119, and I had about $6 in cash.
Nice.
So my total was $784.71 a month ago.
And to be fair, you've made like 60%.
At that point?
At that point.
I was up 60%.
So obviously you're a long way off your target, but you know, making 60% in a year, that's pretty good.
I'd take that for sure.
Yeah.
Yeah.
So what have you done in the past month?
So the good news is that in the last month, Bitcoin has hit all-time highs.
Yep.
So I'm now up just over 25% on my Bitcoin trading position.
Yeah.
Antipa touched an unbelievable 82 cents.
Wow. Okay.
To give context, I bought back in at about 50 thereabouts.
Well, at the start of the year, what did you buy it at?
32.
Okay.
Yes.
Okay. So you'd almost tripled your money if you just held it.
I know, almost tripled. So at this point during the month, this was about 2 weeks ago, I'd actually broken through the $900 mark.
Okay.
And I was like, I am a whisker away here from doubling my money.
It would have felt so good if you'd come in and been like, I've broken 1,000.
I've broken 1,000.
Yeah.
I was a whisker away. I was looking forward to, I was prepping this segment, thinking about it, and I'm like, I'm ready
all that time and energy.
All that time and energy, I'm ready to rock and roll. The bad news is during the last 2 weeks, Antipa came out and raised $40 million through the market at a 60 cent or at 60 cents. And so it fell from 82 cents down to 60. And then obviously my position went along with it. The value of my position went along with it.
And so you're still holding it?
I'm still holding it. Yeah. Again, I didn't have my eyes on the ball, and I didn't realize this until days later.
Okay.
Yeah, I don't have alerts set up for every time Antipa makes an announcement.
Okay.
So they went out and raised money for business operations to extend their exploration and all those sorts of things. But regrettably, what that means now is, I wasn't clued into it. Stock has gone back to 60 cents. And so my position has gone from about 659 to just shy of $500.
Okay. So give us the summary. So you started the month with Antipa, Bitcoin, and a tiny bit of cash.
Yeah.
You closed the month. You didn't trade anything?
No.
All that time and energy, you didn't trade anything.
I went into last month being like, I'm happy with my positions here.
So where are you at?
I am now still Antipa Bitcoin and a bit of cash.
Total portfolio.
Now I'm back down to $633.
So you lost $150 in a month.
I did. And I've tried to buy the ProShares Ultra Bitcoin ETF, which is a
leveraged?
2-time leverage.
Okay.
Because I do genuinely reckon the next couple of months, Bitcoin's going to go pretty well. The issue is you can't do market orders with these leveraged products through the brokers that I'm buying through. You can only do limits.
Oh.
And so for me to put a limit in, because these gap so quickly, like they keep failing.
You just have to be awake when the market's open.
Yeah,
Sure.
11:30 p.m.
Or just get up in the morning.
When do they close? 6?
6 or 7.
Okay,
Yeah.
maybe I'll have to get up early and do it. I'm usually off to the gym, so maybe I'll quickly do it before then.
Just do it on your
It's just so annoying.
Do it while you're walking to the gym on your phone.
Yeah, that's true. That's true.
God.
Anyway, so what I've done, Ren, which is what has kind of deflated me a little bit, is recalculated what monthly percentage I need from here to stay on track.
Okay.
So I'm 5.5 months from the finish line. I need 45% a month to 10 bag my money. So as I've said this whole time, the first hurdle is always the hardest. As Charlie Munger says, making your first 100% is always your hardest. So I'm aiming to double my money still. But yeah, it's certainly an uphill battle from here. So that's where I'm at.
Okay.
But I did want to take a walk down memory lane just to actually look at some of the stocks that I've either held and have let go or have been on the watch list. We had Andrew Brown come in earlier in the year, and as you mentioned in the first segment there, Ren, Drone Shield was on the watch list, and it's up 295% this year alone.
Wow. Could have just bought that.
The first company I ever bought in this challenge based on a screen was Spotify.
Yep.
It's up 54%. Monster Beverage was also on my watch list. It was on a screen. It's up 12, so that's not that impressive. Uber came up on a screen in January. It's up 51%. Strata Minerals, I was in, and it's down 40%. But also Vertiv Holdings, I don't know if you remember that. That was also my first holding with Spotify. It was like a data center operator.
Yeah.
And it's up 111% since Liberation Day. So there's some stocks in there that I've just let go because I've been trying to trade in and out too quickly. If I'd just held some of these, I'd probably be in a bit of a better position.
Yeah. I mean, to be fair, Antipa's up more than 100% as well. It's just you've traded it poorly.
Exactly. Yeah. It's so annoying.
All right. Well, look, we're not going to let this challenge fizzle out.
Absolutely not.
We're going to keep checking in with Bryce.
Absolutely not. If you've got any ideas, let me know. I do take your ideas seriously. I want to give a shout out to Henry, who sent in this idea a month ago. The stock ticker was SNT. He said, boys, have a look at it. Results are dropping in June. So far, they've been immaculate. Must have a look at it. So I looked when the results drop, and the company and the stock fell 28%. So keep them coming through. Thank you, Henry, for the stock tip. Glad I didn't take it. But if anyone has some ideas to help us get there, let us know.
Nice. Well, you lost 20% last month. So
I can recover.
Here's to your next month being better than that.
Absolutely.
Let's ask the community. Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Questions.
We love getting your questions here at Equity Mates, and we do our best to answer them, but sometimes they're a little too personal or too specific, and so we can only offer general advice. That is where the Unhelpful Desk comes in. And Bryce, we've got 3 questions that we're answering today.
Love it. Let's get into it.
The first one is from Sheridan.
Hi, my name's Sheridan, like the sheets. I've been listening for about 12 months. Started investing into shares 6 months ago after I sold my investment property. I invested right before the market fell, so talk about comedic timing, but it seems to have recovered and some. I've got a core portfolio of ETFs, 8 of them, and then a separate portfolio of 14 ASX listed companies. I can't decide whether I want to keep investing into ETFs or pick more individual shares. If this was your portfolio, what would you decide and what would you do differently?
Well, thank you for the question, Sheridan. Now, Bryce, if this was your portfolio, I'm interested to know what you would do, but with the caveat that, Sheridan, we're not aware of your goals, your time horizons, your risk tolerance, so they are all going to be important factors when you decide what you do. But Bryce, generally, how would you approach this question?
Well, with my goals and my risk tolerance, Ren, which is long-term investing, try and build some sort of level of financial independence with a general level of high risk, I would say. What I would be doing is first looking at solidifying the core portfolio without knowing what those 8 ETFs are. I would be looking at reducing those down to just 4 or less for, I guess, broad-based index exposure. If there are any more than that, they would likely be thematic for me. And I would be sort of making sure I keep an eye on those thematic ETFs. In terms of the listed, I think this is a classic core and satellite approach. Nothing wrong with having 14 ASX listed companies. I'd just be making sure that of the 14, there's not huge overlap with the core that you've got going on. You wouldn't want to be, ASX 200 as part of the core and then investing individually in BHP, Commonwealth, the banks and co. So just making sure there's not overlap there. And also making sure that you have a strong thesis for all 14. I think there's nothing wrong with what Sheridan is doing here. And I think deciding between the two doesn't have to be a one or the other decision. Like you can dollar cost average into your core portfolio of ETFs, and then when opportunity strikes, still have fun in the satellite space. So that's what I would be doing. I don't think dollar cost averaging into individually listed companies for the sake of it is the right approach. I'd just be making sure you are buying them when your thesis is there and the opportunity is right.
Nice. Yeah, look, I don't think I have a lot to add. I think the specific question is, would you be investing more in the ETF core portfolio or in individual shares? I think probably I would take a step back and say, what do I want my overall weighting between the two to look like? So for a lot of people, it's sort of like 80% core, 20% satellite. It might be 60-40. I would say you want at least the majority of your money in your core. So at least 51% in your core. And so to answer the question around more core or more satellite, it's decide what percentage weightings you want. And then that money that you've got from your sale of your investment property, allocate it based on the weightings that you want, or to top them up to get the weightings that you want. That would be my first thing. But then, yeah, I agree with you. 8 ETFs for your core probably feels on the higher side. I would ask what like ETF 6, 7, 8 are doing. But if they have a purpose and if they're doing something different, great. And then, yeah, satellite, I agree with a lot of what you've said. I think the important thing with the satellite portfolio is your overall investments are already incredibly diversified by your core.
Yeah.
So you don't need to then like replicate diversity within the satellite part of your portfolio.
Yeah.
So just really focus on like opportunities that you think have meaningful growth that will grow faster than your core, and that you have high conviction over.
And have a look at other markets as well. 14 ASX listed is great, but there's a whole world out there as well. So if you have a broker that gives you access to international markets, get around it.
Yeah. Well, Sheridan, thank you for the question. Remember, if you have a question, you can hit us up at equitymates.com/contact. We love it if you record a voice note. That is what Dave did as well for this question here.
Morning, guys. My name's Dave. First off, Bryce, Ren, love the podcast and all the helpful insights that you guys give. I watched you guys on YouTube for the first time the other day, and I must admit I was very confused, as in my head I had allocated your voices for the opposite person.
Yeah.
I didn't realise Bryce had the booming radio presenter voice. Anyway, I started my investing journey about 18 months ago. The background is mid-30s with a young family. I was really focused on smashing out my mortgage, getting it down where it's fully offset, and now I've got to a point of wondering what to do with excess cash that I was sending to my mortgage, and I've stumbled into the world of investing. At first, like everyone does, I picked some random stocks with little insight, and I've since tried to dollar cost average into a more sensible, long-term, diverse portfolio. So anyway, I'd love to hear thoughts and see where I could improve. Thanks, lads.
Love it. Thank you, Dave. And you're not the only one who has been confused when you look at us on YouTube and figure out that our voices don't match what you think they are.
Yes. That is offensive to someone.
Who
probably
knows?
me. I don't know. But look, I think, Dave, first of all, well done. Like, you set out your goal to smash your mortgage. You've done that. And now you're trying to figure out what you're going to do with that free cash that you were using to smash out your mortgage. So congratulations. The fact that you're in your mid-30s and you've done that is pretty amazing.
It's awesome. Yeah.
So I think start there. In terms of what you're going to do next, I think, again, this is a challenge where we can't give personal advice. And even if we could give personal advice, we just don't know you well enough. We don't know what your goals are. We don't know what, you know, where you're living and where you want to live. We don't know what your work situation is and what your dream work situation is. We don't know your time horizon and you know, what you want to do in terms of working till you can't work anymore or retiring early or stuff like that. So there's just a lot of unknowns. But I think generally start with answering those questions yourself. What are your goals? Because that should then determine your investment strategy.
Yeah, if I was in Dave's position, I would be thinking about, all right, mid-30s, young family, what can I now be doing to set my kids up for school, for example? Like, are there some long-term planning I can do there? The type of free cash flow that I've got, can I be thinking about assets that are going to give some sort of tax advantage? Like, could I be looking at an investment property or an investment loan, for example?
Or, I mean, the most popular term in the equity mates community at the moment, debt recycling.
Or debt recycling,
like if you've smashed out your owner-occupied mortgage, then you could start looking at, well, it's not debt recycling. It's just redrawing your mortgage as...
Well, it sounds like he's just, fully liquid in his offset account to the value of the mortgage. So there's a fair chunk of cash that you could recycle there for sure. So yeah, all those things. It's kind of like you've knocked off like the most important drag on building wealth, which is non-deductible debt. Because you've done that, you can actually now start supercharging building wealth, is the way I would be thinking from Dave. So it's like, figuring out the asset classes that you can do to sort of reduce tax and then aggressively putting that money in the market as fast as possible.
Yeah. And when we say aggressive, we don't mean like take incredible risk with the stock picks that
No.
You don't, like, you're in a good financial position where you don't need to be chasing 10 baggers like Bryce is for some
it's a lot of fun.
stupid reason. But, you know, like getting that 8, 9, 10% a year return from, you know, maybe it's an investment property, but, you know, we would say you could get that from the stock market. That's all you're going to need. So figure out your goals. Think about like when you're going to need the money and then invest accordingly.
Yeah, love it.
All right. Well, the final question that we're doing for today's Unhelpful Desk comes from Angus, and he also recorded a voice note.
G'day, Alec and Bryce. Angus here. Big time fan of this wicked resource. Fairly new to my investing journey, having only just set up my personal portfolio a year ago. I would say I'm a mostly passive investor with a fairly aggressive stance to my dollar cost monthly averaging approach with a 30-year investing horizon. I have an 80% core, 20% satellite structured portfolio and would like to review my exposure across sector and geography and whether I should be including more dividend-based funds/stocks at this stage of my investing journey. I'm also concerned about my individual stock allocation of 20% of my portfolio across 4 individual stocks. It's easily the most entertaining part of my portfolio, but I'll be the first to put my hand up and say I don't know how to value a business besides placing an opinionated value based on their business reports and online opinion/AI for future growth potential. Am I placing too much of my portfolio in a more active state for my position? Is dollar cost averaging okay for individual stocks? And what are some more tools for assessing the 4 individual businesses I have and making decisions about them?
Love that from Angus.
Yeah.
Thank you for support. Thank you to everyone who's submitted questions for supporting the show. Loving these questions that are coming in.
I'm also loving how sensible and long-term a lot of people are when they're thinking about investing and setting themselves up. And
yes,
I'd like to think that
guys, give us some questions for the 500 to 5,000. I'm happy to answer them.
No, that's good. It's like, you know, a lot of the themes that we constantly bang on about are being reflected in these questions, which is nice.
Yeah. Absolutely.
Now, Angus, you gave us a bit of information about yourself and your goals, and I think they're all very sensible, but we're just going to answer, I guess, some of your questions at the end generally. 80-20 satellite portfolio, and then the 20% satellite portfolio split across 4 individual stocks. I think we can start there and answer the question: is 4 stocks 20% of your portfolio? Is that how do we think about that?
I mean, I personally don't have anything wrong with it. I think if you were to ask experts, they'd probably say 5%, 5 to 10% is the max you would go. But I would. 10% is the max you would go. Or 5-10%. Like some of them are saying, well, we've had Dawsey in like
True.
multiple times and say you don't win any more than 5%. So I just don't want people to confuse themselves. But I personally have nothing wrong with that, because I think if you've got 80% of your core portfolio in well-diversified ETFs, you've got thousands of stocks that you're exposed to then have 4 that make up 20%. Sure, you need to be comfortable that if one of those does tank, then it will have an impact on that 20%. But like overall diversification, you're pretty solid.
Yeah, I agree.
I wouldn't be concerned with, personally, I wouldn't be concerned with that weighting.
Yeah.
Yeah. I think nothing wrong with having a concentrated satellite position.
Yeah. You just go in eyes wide open that it's a large position and that, individual stocks can go to zero and all of a sudden you've cut 5% of your portfolio off.
Yeah.
But yeah, you would be comfortable with that weighting.
Definitely. So the second part of the question was around, should we be adding more income to the portfolio? With a 30-year time horizon, personally, I would be focusing on growth right now, unless you have a specific reason for needing income right now. But if the overall goal is to get a pool of assets that generate income over the long term, I would be trying to grow that pool as fast as possible and then slowly transitioning to income producing assets.
Yeah, I think what we've learned is that people love the idea of passive income.
Yeah.
And we love that idea as well. There are growth assets that are great for growth, and there are income assets that are great for income. And there are some that try and do both, but by trying to do both, they don't do either as well. Yeah. And so what we've learned and how we think about setting ourselves up for passive income in our future is focus on growth while you're trying to grow your assets. And then when you're at a point where you have enough to generate passive income that ticks your goals, whatever they are, quitting your job, retiring early, or just like taking a lower paying job so you can spend more time with the family, or you can have a shorter commute, or you can do something you love, whatever it is, at that point, then switch to the income producing investments that are set up to be great at that. What we don't think works is trying to do both things at the same time.
Yeah.
It's suboptimal.
Yeah.
So that's how we personally think about finding that balance between growth and income. Take that and then apply your personal circumstances and goals to that general thought around growth and income assets.
Yes. This final 2 parts of the question were, what do we think about DCAing into selective stocks, and then how to actually understand the businesses in more detail. In terms of DCAing into stocks, I don't know what you think, Ren, but I feel like people do it for the sake of doing it. For me, it's different to the core. I'm more like a buy the stock and then don't just put in an automated monthly. It's just like if the opportunity presents, continue to buy, but like an automated buying for the sake of it, I think you can come unstuck a bit.
Why?
I just feel like you have to pay a lot more attention to it. It gets you into the mindset of not paying attention if it's just automated in the background. I think it's more of an emotional thing for me.
Yeah, okay, that's fine. Yeah. I would say any individual stock you own, you should be paying attention to it. And if you're not someone who wants to pay attention, then just stick to 100% core, low-cost, diversified index ETFs. The fact that you're investing in individual stocks, let's say, take it as a given that someone is paying attention, and so if the bottom is about to fall out of a stock, they are aware. I have no problem with DCAing into individual stocks.
If you're that into it, then of course.
Because all the same logic applies. You average out the purchase price over time. But importantly, you also take the decision-making and the emotions out of, is now the right time to buy the stock?
Yeah.
Because you can always convince yourself that it's...
all-time high, it's not going to buy.
Yeah. Or on the flip side, there's some risks here and it's going to fall and I'm going to be tactical and wait until it falls. And then all of a sudden it doesn't fall. So all of the same logic for DCAing into ETFs, I think applies to DCAing into individual stocks, with the one caveat that just generally individual stocks are riskier and more volatile and have a higher chance of going to zero.
Yeah.
So yeah, you're right. You have to be paying attention.
To answer the question around how to understand businesses more, Angus, I will just direct you to our 4 steps to analyze any business free download.
Nice.
We'll put a link in the show notes. 4 steps around understanding if it makes a good product or service, how it continues to generate profits from that, if it can reinvest those profits in productive ways, and then if you can buy it at a reasonable price. 4 simple steps to at least get you on the path to understanding the investments that you've bought.
All right, well, that does it for this episode. Thank you to Sheridan, Dave, and Angus for submitting their questions. If you have a question, you can hit us up at equitymates.com/contact. A reminder that every morning we send a daily email giving you a dot point summary of the news moving markets. Give it a try. You can always unsubscribe if you don't enjoy it, but we're pretty confident you will. The link to sign up is in the YouTube description or the show notes. But Bryce, that does it for this episode.
Love it.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.